Welcome. Today's Thursday, May 26th. I'm Jeff Huge, Chief Investment Officer at JWH Investment Partners and the editor of Alpha Insights. And this is your Daily Five. As you know, the Daily Five is the show where we try and go through five charts that are very, very important to what's going on in the market today. And we've got some interesting topics to discuss. So let's jump right into it and take a look at chart number one. We've been hearing repeatedly over the course of the last couple of days from financial media that we are at a low, that the market has bottomed, that we are near a buying opportunity of a lifetime. Is this another buying opportunity of a lifetime? Let's explore this idea first by just defining what that means. So, buying opportunity of a lifetime, or what we'll call a BOL from here on in, by definition is a once in a lifetime chance to buy at a price that will never be seen again in your lifetime. Well, with many declaring that the recent 20% decline in share prices is such an opportunity, we wanted to kind of take a look at what really represents a buying opportunity of a lifetime. And, past such BOLs have had one thing in common. They've all occurred at low valuation levels as defined by the Shiller CAPE ratio, the cyclically adjusted PE ratio. And that range has been about 5 to 13 times. If we go all the way back to 1920, where we saw the low of 4.8 times, or the 32 low at 5.2 times, or the 42 low at 5.6 times, or name your low up until the crash of 87, they were all single-digit CAPE ratios. Now, things changed somewhat in 1987. That low was marked by a 13.4 multiple on the CAPE ratio. And so, we kind of had this new kind of paradigm where, low teens multiple would then be a place where you could get in and never have to worry about ever seeing that price again. Again, in 2009, we saw a 13.3 PE. And again, we saw a teens CAPE ratio during the COVID crash. That came in on March 2020 at 19.8, so just below 20 times. Substantially higher than what we saw back in 2009. And what's really interesting is that the tops have been marked by, 30 plus PEs, 32 and a half in 1929, 42.2 in 2000, and 38.6 most recently in January of 2022. As of Friday's low, the Shiller CAPE ratio registered a multiple of 31 times. Now, the question that I have is, if today's 20% haircut to prices is another buying opportunity of a lifetime, then why is the valuation at 31 times more representative of an epic market top such as 1929, when the CAPE ratio at that time was a peak, an epic peak at 32 and a half? Let's try and answer that question with chart number two. So the answer to the question is, maybe we've experienced some stock market inflation. Perhaps, the best way to answer that is illustrated by the very tight 2-year correlation since March of 2020 between stock prices and the expansion of the Fed's balance sheet. Stock prices actually rose in lockstep with the Fed's asset purchases, which pumped an unprecedented level of liquidity into the system since March of 2020. The problem is, beginning on June 1st, the Fed has announced that they are going to begin to reduce the size of their balance sheet. Now, that balance sheet grew from about $4 trillion to almost $9 trillion. The plan, as it's stated, calls for a reduction of about $402.5 billion before year end. That's about 4.5% of the Fed's balance sheet. Then another 1.14 trillion in 2023. So they're going to take another 13.3% off. And presumably in each year thereafter until they get back to some normalized level. But from our perspective, If we look at the green line, which represents the Fed's total treasuries and mortgage-backed securities held by the Federal Reserve, their balance sheet per se, it's really no wonder that the market doubled as the Fed doubled the size of its balance sheet. And the question investors have to ask themselves is, in this period of low growth, high valuations, and inflation rates heretofore not seen for 40 years and seemingly somewhat persistent, will the market now shrink proportionally with the Fed's withdrawal of this liquidity? Let's take a look at the market. Chart number 3 suggests that the S&P 500 has already responded in anticipation of this coming change. As investors are re-rating companies based on the prevailing market conditions, PE multiples have contracted now from around 22 times forward earnings to just 16.6 times the estimated forward 12-month EPS. And this whole step function was visible to market technicians as the price action in the S&P 500 developed a classic pattern top formation of the head and shoulders variety. Technicians will know that this is a very specific pattern with very specific downside projections. So we're able to count in an orthodox manner a target price that actually is substantially lower than where we are today. The breach below trend support and chart support at 4,300 back in mid-April confirmed this pattern, and it now projects a measured move to approximately S&P 3,500. And that's a critical area because there's a significant number of support levels that coalesce around that. First and foremost, the 200-week simple moving average, also coinciding with the 50% retracement of the entire advance off the March 2020 low. There's a third area of support, which is really prior weekly highs that defined a consolidation range from August to November. All of that comes into play right at 3,500, and that's pretty much exactly where this pattern targets. So we don't think we're all the way there at this point. We have no doubt that the market was set up for a short-term bounce, a rally that will give some relief to the oversold condition, allow the market to consolidate before the next wave down, in our opinion, which targets 3,500 on the S&P. Let's take a deeper look at that. Chart number 4 goes into our Elliott Wave analysis. Elliott Wave is a special discipline that really identifies each and every move waveform within the advance, going all the way back, in this case, to the 2009 lows. So we would define the March 2009 low to the January 2022 high as cycle wave 5. It's a 5-wave advance that is subdivided. We've been able to identify each high and low within that subdivision. And the peak really at 4,800 is a high confidence target for cycle wave 5. And if in fact that proves correct, then we are in a corrective waveform right now that will ultimately trace out something like an ABC pattern that we've diagrammed on the left-hand side of this chart, which could take us all the way back to the 61.8% retracement of that 13-year advance. That level comes in right around 2250 on the S&P 500, which is near a prior 4th wave low, which is a very typical place for the market to retrace and consolidate to. So what we're looking at on the right-hand side of the chart is kind of this blown up sort of segment of that larger pattern, just the last wave formation, or wave 5, primary wave 5 that is, of this final move to the 2022 high. And from that high, we've traced out an identifiable 5-wave down pattern to intermediate wave 1 down, and a 3-wave pattern defining intermediate wave 2 up. And from our analysis, we believe that we're in the midst of intermediate wave 3 down. Now, intermediate wave 3 down should target that 3,500 level that we've talked about before a more meaningful consolidation builds. And that would likely be wave 4. And then we would expect wave 5 to carry all the way down to around 3,200 on the S&P 500, which is a 38.2% retracement of that 13-year advance off the March 2009 low. At this point, we really want to focus on the current wave in progress. That's intermediate wave 3 targeting 3,500. We would use the current advance or bounce off Friday's low as an opportunity to sell, lighten up equity positions, and raise cash ahead of an expected decline to 3,500 on the S&P 500. Wave 5 gives us an example of what's happening in the market today. This is a chart of NVIDIA. We showed this chart about 4 or 5 weeks ago, just as it was about to break its trend line. It hadn't broken yet, it was holding above support. But our anticipation was that, based on the pattern that developed, NVIDIA would fail along with all the other FANG stocks. And we've been talking about these for a while. Last week, we really highlighted Apple. The week before that, I think we highlighted Microsoft and Google and Amazon. And today we really want to drill down on NVIDIA, who reported the results last night. They were disappointing, but NVIDIA is the 10th largest stock in the S&P 500 by its market cap weight. It's about 1.2%, but also it's the 7th largest weight in the NASDAQ 100, coming in at over 3%. It has an enterprise value of just under $410 billion. But it trades, despite the fact that the stock's down 50% from its high, it still trades at 29.6 times estimated forward earnings and 15.7 times trailing 12-month sales. These are outrageous multiples relative to the market's multiple. And relative strength versus the S&P has been deeply negative for some time, and it's now accelerating lower despite this morning's bounce. The stock has breached its uptrend back in mid-April, as we suspected it would, and it's since developed the characteristics of a classic pattern top formation of possibly an irregular double top, or what we've labeled a inverted cup and handle variety. The bearish inflection below 205 confirms that this pattern's operative, and it actually projects a measured move to about 120 initially, which is where the 200-week moving average comes into play. And if it breaks that level, we could see the stock trading as low as $60 a share. NVIDIA is a great example of what happens when leadership fails. And when big stocks like this, which are leading the market, break down, they take the market with them. That's all we had to talk about today. Beware of these conditions. We want to thank you for joining us and wish you the best. If you want to follow up with me in person, you can contact me via my website, www.jwhinvestment.com, or you can follow us on Twitter @alpha_insights. I'm also on OETV and LinkedIn, or just send me an email at jhuge@jwhinvestment.com. Again, thank you for your time today, and good luck trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.